Hello. We're having a good discussion here. Let's continue it in regards to accounting. Okay. Last class period, I think we wrapped up some Chapter 10 subjects in regards to fixed assets, didn't we? And I think I have about 3 or 4 exercises and quick studies for us that I assigned as homework. We're going to go over those. And then we're going to start the chapter, our last chapter in this class, Chapter 11 in regards to current liabilities. And that's actually a pretty quick and easy chapter. All right, so we are definitely getting to the end of it. Let's go to the homework that I assigned. And I believe the first one I assigned was Quick Study 1011. Okay. That one was a pretty easy one, wasn't it? Okay. Quick Study 1011 says, which of the following assets are reported on the balance sheet as intangible assets and which are reported as natural resources? Okay. All right. I'll go through these and you tell me the answer. Timberland is a natural resource. It's like forestry or whatever. A patent is what? Tangible asset. A leasehold is what? Intangible. Also an intangible asset. What about an oil well? Natural resource. Natural resources have to do with the earth and stuff like that. Equipment. That's a trick question. It's not an intangible. It's not a natural resource. That's just a regular plant asset. Okay? I know, they didn't even offer that as an option, so they're kind of tricking you. Copyright is what? Intangible. A franchise, an intangible. And a gold mine would be natural resource. That was easy. Don't you hope that's how the whole final is? Yep. Okay, any questions on that? All right, let's go over to exercise 1016. All right? Exercise 1016. And this one has to do with the disposal of assets, correct? All right, Millworks Company owns a milling machine that cost $125,000 and accumulated depreciation and has accumulated depreciation of $91,000. Prepare the entry to record the disposal of the milling machine on January 5th under each of the following independent assumptions. Okay, well, remember the 5 steps of disposing of an asset? What was the first one? It was update depreciation to the day of disposal, correct? Okay. Well, we're assuming here that they did depreciation out on December 31st. Okay? So we don't really have to update depreciation because we've only had it, there's only 5 days that we've had it and hasn't been depreciated. So we do not have to depreciate for such a small period of time. In other words, that first step, updating depreciation to the date of disposal, it's already done for us. Okay? So we can move on to the second, third, fourth, and fifth steps, which is basically building that journal entry. We remove the asset from the books. We remove the accumulated depreciation from the books. We record any cash given or received, if there was any. And then the last thing we do is we say, does this journal entry balance? And if it doesn't, then we either enter a loss on disposal if we need help on the debit side, or a gain on disposal if we need help on the credit side. And remember about gains and losses. I know I've said this, but I'm going to repeat it again. A loss is kind of like an expense. It has a debit balance. It's on the income statement. It's deducted in arriving at our net income. It's a temporary account, and it's closed at the end of the period. A gain is kind of like a revenue account. It has a credit balance. It's added in arriving at our net income, and it's a temporary account as well. Okay? So, let's take a look at this. All right. Okay, the first situation was the machine needed extensive repairs, and it was not worth repairing. Millworks disposed of the machine, and they received nothing in return. Okay? So they just threw it out. Okay? Now, one thing that they did in the solution manual that you really almost didn't need to do was they did go ahead and figure out what is the book value of the milling machine. Okay? Now, remember, book value is cost minus accumulated depreciation, correct? So the cost is 125, the accumulated depreciation is 91, the book value is 34. Now the book takes more of a stance of comparing the book value of the asset to whatever we received and figuring out if there's a gain or loss that way. I take more of an approach of just build the journal entry, knowing that a journal entry has to balance. The total debits have to equal the total credits. But either way, this is what you get as your journal entry. All right, did you guys get that? Okay. What about the next scenario? The next scenario says we sold the machine for $17,500 cash. Well, we remove the asset, we remove the accumulated depreciation from the books. Now we have to record the cash that we got of $17,500, and then to balance this journal entry, we had to debit loss on sale of milling machine for $16,500. Cool? All right?
Can you write loss on disposal, or is it?
Yeah, you can just write loss on disposal.
Okay.
Okay, the third scenario is we sold the machine for $34,000 cash, which is exactly the book value, which I'm going to guess means that we didn't have to record a gain or loss because the journal entry balanced on its own. Is that correct? All right. The fourth scenario, we sold it for $40,000 cash. Okay. And there's our scenario there. There, to balance the journal entry, we needed help on the credit side, correct? So we credit, just like a revenue, we credited gain on sale of milling machine, or just gain on disposal, gain on something, okay? And there are our journal entries. Any questions on those? I find it easier just to kind of build the journal entry, like I said. So hopefully that worked well for you. I always figure we have to make the journal entry anyway. So we might as well just do that and let that answer the questions that we need answered. Okay? All right. Exercise 1019. Is that correct? Let's go through that. All right? Exercise 1019. Bush Gallery purchases the copyright on an oil painting for $236,700 on January 1, 2011. Must be a really nice painting, huh? The copyright legally protects its owners for 12 more years. The company plans, though, to market and sell prints of the original for 15 years. Prepare entries to record the purchase of the copyright on January 1, 2011 and its annual amortization. Okay? All right, let's do that. Okay, first of all, let's record what when we purchase the copyright, what that journal entry is going to look like. Okay? And that's just going to be a debit to copyright, which is an intangible asset, long-term asset, and a credit to cash for $236,700. Okay? Now we need to amortize this. Now amortizing is kind of the equivalent of depreciating or depleting. Remember, we depreciate plant assets, we deplete natural resources, and for intangible assets, we amortize. Okay? So do we amortize this thing over 12 years or 15 years? Because it gives us two time periods. You always do the one that's less. Okay? So 12 is less, so you're right. So what that journal entry looks like is this. We take the two, there's no salvage value that's given, so we have to assume 0. 236,700 minus 0 divided by 12 years equals 19,725. Now we debit amortization expense, okay? Amortization expense, and we credit accumulated amortization. I don't want to see the words depreciation or depletion in there, okay? And of course, accumulated amortization is a contra asset, just like accumulated depletion and accumulated depreciation. Has a credit balance. All right? This was pretty easy homework tonight, wasn't it? Okay? Okie doke. One last one, and then we're done with chapter 10. All right? And I believe I believe this last one is over asset turnover, is it not? Okay. Okay, exercise 1022. Joy Company reports net sales of $4,862,000 for 2010 and $7,542,000 for 2011. End of the year balances for total assets are 2009, $1,586,000, 2010, $1.7 million, and 2011, $1,882,000. Compute their total asset turnover for 2010 and 2011, and then comment on Joy's efficiency in using its assets if the competitors average a total asset turnover of 3.0. Okay? All right, well, let's do that. Let's go ahead first and just look at the computations. Now, the formula for total asset turnover is our net sales divided by our average assets, correct? So for 2010, we're going to take net sales of $4,862,000 divided by the total of assets at the beginning of that year plus the end of the year divided by 2. We're just figuring the average there in the denominator, aren't we? Okay? So we get 2.96. Don't round that. I like to keep those to 2 decimal places. Okay? Then for 2011, same rationale. We get an total asset turnover of 4.21. Did you guys get that? Okay. Any questions on how those numbers were derived? All right. Cool. All right. Okay, now let's comment on it. Well, are things getting better or are they getting worse?
Better.
Yeah, you always want to know, is it like golf? You want a low score, or is it like bowling? You want a high score? With these ratios, some of them we prefer them to be high, sometimes we prefer them to be low. This is one we want it to be high. We want there to be an efficient use of our assets. Now, what are our competitors averaging? 3.0. So it looks like we are, at least in regards to this ratio, we're outperforming our competitors. Of course, we have to analyze a lot of other things too. But, and you want to make sure you compare it to a competitor, right? You would never want to compare the asset turnover of a law firm to the asset turnover of a steel manufacturer, right? Because some companies have a lot of assets and some companies don't. Some companies require a lot of fixed assets to do their business and some don't, right? Okay. When I was in consulting, if I would have figured out my total asset turnover, it would have been astronomical because I really didn't have any assets. I had a computer. Back then I had a fax machine. And that was about it. Maybe I had a couple of receivables on the book and maybe I had a little cash in the bank. But I just didn't have a whole lot of assets, right? Think about it. Think about it like being a real estate person. Does a real estate person, just somebody who sells real estate, they don't need a lot of assets, right? Okay? They don't need a lot of assets to do their business, okay? But there's other things like a car manufacturer or, a steel manufacturer or something like that where you need millions and millions of dollars of assets, don't you? Okay? All right, cool. Enough about that. We're done with chapter 10, right? So now let's go into, with our remaining time, let's go into chapter 11, okay? Now, chapter 11, it goes pretty quick because there's a lot of things in chapter 11 you're going to think, haven't we already talked about this? And there's a lot of things, yeah, we already have talked about, okay, in one chapter or the other. So some of it may seem pretty familiar. But this chapter is on current liabilities and payroll accounting, Okay? So let's dive into it. Let's talk about what a liability is, first of all. The liability is you have a present obligation because of something that happened in the past, and it's going to require future sacrifices. Okay? That's kind of a clever way of bringing all the different, time tenses in there. But it's something we owe right now because of something that happened in the past, like a purchase or people did work for you, and it's going to require a future sacrifice, more than likely the payment of cash to the appropriate person or company. Okay? Now, we need to classify our liabilities, and I really want you to focus on the top half of these definitions. A current liability is expected to be paid within a year, generally speaking, and a long-term liability is expected not to be paid within the year. Okay? That's pretty simple, isn't it? You just ask, when is this due? Is it due within the next 12 months? If so, it's a current liability. If not, it's a long-term liability. Okay? They have these other exceptions in regards to the operating cycle, but I don't really want you to focus on that so much. I really kind of want you to think of the 1 year versus the 1 year guidepost. The 1 year, is it less than 1 year or is it more than 1 year? Okay? There are a lot of liabilities that are known or determinable. We know how much they are. We know who we pay. We know when we need to pay by. They give us examples like accounts payable, which we've talked about. We're going to talk about sales tax payable. We have unearned revenues. We're going to talk about short-term notes payable and payroll liabilities, and then multi-period known liabilities. So those are some of the subjects that we'll go through in this chapter. Okay? What about sales tax payable? Okay, well you guys understand this thing about sales tax, right? Okay? My kids are learning this, right? My kids will save up for a computer game that's $50, and they'll say, hey, I've got $50, let's go buy that game. I've saved up enough money. And I'm like, have you learned about sales tax, son? No, what's sales tax? Well, I've got some bad news for you, right? Because to buy a computer game at Walmart or Best Buy, if the game is $50, you're going to have to give them more than $50, right? In a way, does anybody here work retail? Ever worked retail? I've asked this before, I don't remember. Jake, you did? Okay. You are collecting. All these retail stores act as collection agents for the government, right? They are collecting sales tax. Do you get to keep that sales tax? No. You've got to give it to the government. Okay? So let's look at an example. On May 15th, 2011, Max Hardware sold building materials for $7,500 that are subject to a 6% sales tax. Okay? Now, we are going to collect more than $7,500 of cash from that customer. We're going to figure out what the sales tax or the sales tax amount on that is. Well, 6% times $7,500 is $450. So they're actually going to give us $7,950, right? Now, $7,500 of that is ours to keep, but the other $450, that's not ours, is it? We're holding that for the government. Okay? And so we have to set up this short-term liability or current liability, sales tax payable, to the government until we send that in, or however we remit that to the government. The government's going to get very cranky if we don't remit our sales tax to them. Okay?
Does the government estimate how much sales tax you're supposed to be bringing in? Do they compare it to your sales, or?
Well, of course we know our sales tax rate. But
Yeah.
you're saying, do they look at it, just make sure you're not?
Yeah, like what if you gave them a different amount than, what if you were keeping some of that money or something?
Yeah, I don't know all the reports, but I know you probably figure out what your you tell them what your sales were for the period, and then remit the appropriate amount. And if you tried to just make cash sales off the record and not charge sales tax,
I mean, I know you'd probably get in big trouble.
That would make the government very upset with you if they found out. Okay, you'd be in big trouble. Okay. Okay. Let's talk about unearned revenues. We've spoken about this before, haven't we? Remember our old buddy, the revenue recognition principle, way back in chapter 1? Remember what that states? We recognize revenue when it is earned. When is it earned? When we provided the product or service, and not until then. It doesn't matter when we receive the cash, correct? It's when we've provided the product or the service. So example, on May 1 of 2011, A1 Catering received $3,000 in advance for catering a wedding party that will take place on July 12, 2011. Now on May the 1st, we received that money, but we cannot recognize that as revenue, can we? We have to book that as unearned revenue. And do you remember what type of account is unearned revenue? It's a liability, right? How do we earn that? How do we decrease that liability? By providing that service of catering on July 12th. Okay? So when we do that, that's when we can reduce that liability by debiting it. So unearned revenue is debited and we can book it as revenue. Okay? We have to recognize the revenue. Let's go back in time a little bit. What if they pay us the money? We recognize it as unearned revenue, and then what happens if that wedding is called off? Well, it depends on what your return policy is, but if you don't have one, you've got to give them that money back, right? Correct? You haven't earned it yet. Okay, but let's assume that they have the wedding, it's a wonderful gala, and they're happily married for many, many years. We recognize that revenue when it is earned, and it's earned when we've provided the catering services. Correct? All right. Okie doke. Questions on unearned revenue? All right, I'm kind of yakking a lot up here, so I don't like to lecture too much because I'm afraid people will fall asleep. So let's go ahead and just do a few quick studies. Let's go ahead and do quick study 11.2 and quick study 11.3. I don't believe those will take too long. So let's go ahead and do a quick study 11.2 and quick study 11.3. right, let's go over those. I don't think those were too difficult. Quick study 11.2. Record Computing, it's an unfortunate name. Record Computing sells merchandise for $5,000 cash on September 30th. The cost of the merchandise is $2,900. The sales tax law requires Record to collect 4% sales tax on every dollar of merchandise sold. Record the entry for the $5,000 sale and its applicable sales tax. Also record the entry that shows the remittance of the 4% tax on this sale to the state government on October the 15th. Okay? All right. Well, when we sell that merchandise, we actually have two journal entries we have to make. Okay? You might have forgotten the second one to record the cost of inventory sold. But focusing on that top journal entry, our sales were for $5,000, right? What's 4% of $5,000? It's $200. So we're going to collect $5,200 total from that customer. $200 of that is not ours, though. We're acting as a collection agent for the government. So we have to set that up as a sales tax payable to the government, right? Okay? And then, of course, we need to decrease our merchandise inventory and book our cost of goods sold, a la Chapter 15. Now, when we pay the government on October the 15th, it's just like the reduction of any other liability. Okay? Did I say something wrong?
Chapter 15.
Oh, sorry. Thank you. You remind me when I say stupid things, okay? Grandpa's getting old. Okay, when we pay the government on October the 15th, we record it just like the payment of any other liability, right? Cash is credited and the liability is debited or reduced, right? That's not too difficult, is it? Questions on Quick Study 11.2? Okay. Let's go to Quick Study 11.3. Tickets, Inc. receives a $5.5 million cash in advance ticket sales for a 4-date tour of Bruce Springsteen. Record the advance ticket sales on October the 31st. Okay, let's do that first. Okay, Ticket, Inc. gets this money, $5.5 million worth, and they have to book this as unearned revenue. You could have just said unearned revenue, but they use the title unearned ticket revenue. And why is this unearned? We haven't provided the service of the Bruce Springsteen concert yet. Okay? Right? So this is a big old liability account, is it not? Okay? And let's go on then. So that's what we do on that date. Record the revenue earned for the first concert date of November 8th, assuming it represents 1/4 of the advanced ticket sales. Okay, well, we have now provided 1/4 of the services, right? So what's 1/4 of 5.5 million? It's 1.375 million, isn't it? So after they do that first concert, we can decrease unearned ticket revenue liability by debiting it, and we can book it as revenue, earned ticket revenue, or you might have just said revenue or earned revenue or something. Okay? So that's how that goes. Any questions? This all seems like review, doesn't it? Okay, I believe we've got a little bit of time left, so let's go ahead and talk a little bit about the next subject, which is short-term notes payable. Now, some of this may seem really familiar because we just talked about notes receivable, right? This is just kind of the same rationale, it's just on the other side of it. What's a short-term note payable? It's a written promise to pay a specified amount on a definite future date. And if it's a short-term note payable, then it's within a year, pretty much. Okay? Now, let's look at an example. Now, this is a situation where our company owes $5,000 on accounts payable. And for whatever reason, maybe we're having cash troubles or the economy's bad or all of the above, we can't pay that $5,000 account payable. So we're going to replace that account payable with a note payable. It's going to give us a little more time to get our money together. It's going to charge interest. And you know, a note payable is something that's signed as well, right? So it's going to give the person who's owed the money a little bit more peace of mind. Remember the difference between an accounts payable and a note payable is a note payable is written down and there's usually interest involved, right? So on August 1st, 2011, Matrix Inc., that's us, asked Carter Company to accept a 90-day 12% note to replace our existing $5,000 account payable to them. So we would make the following entry. We would decrease or debit the accounts payable we had to them and set it up as a note payable. You with me? All right. And then we pay the note on October 30th plus interest to Carter. Okay, now let's go back one slide. We're not just going to have to give them $5,000, all right, are we? We've got to give them the $5,000 principal plus the applicable interest. Okay, remember how we computed interest? Interest is computed by taking the principal of the loan of $5,000 times the annual interest rate of 12% times 90 divided by 360 because this is a 90-day note. And you could do 365, 90 divided by 365 if you want. I mean, I recognize that there's 365 days in a year. But we usually do 360 because it's just easier math. All right? So we have to give them not just $5,000 but $5,150. And we reduce the note payable by the principal amount, and then we book the other $150 as interest expense. Do you remember doing this? Okay. Questions on that slide? This is kind of what a note looks like. Okay, we've looked at that before. It says that the face value, the person who owes the money signs it, states what the interest rate is, etc. Let's look at another example. Now this is another situation of a note payable, but instead of replacing an accounts payable, this is where we just like get a short-term loan. So on September 1st, 2011, Jackson Smith borrows $20,000 from American Bank. The note bears interest at 6% annually or per year, and they are due in 90 days. So this is a short-term notes payable. Okay. So here we get a little loan, right? So we debit cash for $20,000, and we credit our note payable for $20,000. You with me? Okay. Now, when we pay that back, once again, we have to pay the principal amount of $20,000, but we have to figure out how much interest we also have to pay. All right? And in this case, it's $300. The $20,000 face amount of the note times the annual interest rate of 6% times 90 divided by 360 because this is a 90-day note. Okay? All right. What about your end-of-period adjustments to notes? Okay. Well, remember, if you originate a note on a certain day and the maturity date, well, let me say this a little different. If you have an end of the period and you're going to do financial statements as of that date, and this is between when the note originated versus when it matures, then you have to record an adjusting journal entry to record the interest expense that's incurred to that date. Remember doing this with a notes receivable? Okay. For example, we saw on December 16th, 2011, we borrowed $8,000 by signing a 12% 60-day note payable. Now, this note is not due till February 14th, but we do our financial statements as of December 31st, 2011. So we have to record an end-of-the-period AJE to show that interest that is due. We don't have to pay it that day, but we do have a liability that day, and we have to book that expense in the proper period. Okay? So how would we do that? Well, how many days have gone by? 15 days between those? Okay. So we have to make the following adjusting journal entry. Well, okay, first of all, they show us the journal entry when the note is created. Okay? But then on December 31st, the adjustment, this is the adjusting journal entry down here, we have to take 8,000 times which is the face amount of the note, times the 12% interest rate, times 15 divided by 360. And we counted out that 15 on the previous slide, right? 15 days between December 16th and December 31st. We don't have to, like I said, there's no cash outlay that day, but we have to book the interest expense and then book the interest payable. You with me? Okay, then when we actually pay off this note, we make the following entry. Okay? Now I do this a little different, but let's show what it is. Okay, I like to figure out what's the total amount of interest that we have to pay. Okay? So in this case, this was a 60-day note, right? If I figured out the total amount of interest that has to be paid, I would take 8,000 times 12% times 60 divided by 360, and I would get $160. You with me? So then what I would say is, okay, well, I have to give them cash of $8,000 for the principal, and I have to give them $160 of interest. That's the total amount of interest. Then the next thing I would do is I would reduce my note payable by the principal amount, and then I would ask myself this: of that $160 total interest, how much of that has not yet been recorded as interest expense but needs to be? Well, $120 of it, right? Because we recognized $40 with the AJE. So then I would book this part of the entry, and then I would say, okay, this journal entry needs to balance, and that has to be to reduce the interest payable that we set up with the AJE. So you can approach that journal entry different ways. They approach it by focusing on that 45 days between the financial statement date and the payment date. But I like to kind of ask myself, okay, what's the total amount of cash I have to give them? Principal plus your total interest. Whichever way works easier for you. Okay? And there we shall stop. Okay? So, let me go ahead and give you your homework. Let me write it down and I'll put it on the overhead. All right. Pretty easy assignment. Pretty short and easy, okay? Okay, here we go. For homework, I want you to do one quick study and one exercise. Okay, that's all you have to do. And we shall see you next time, folks. Bye-bye.